Hello and welcome. We'll just wait a couple of moments while people start to arrive. Kia ora, good afternoon and welcome. We'll just wait a couple of minutes while people arrive. Tēnā koutou katoa, ngā mihi nui kia koutou katoa. No mai, haere mai. It's my pleasure to welcome you to the third of our 5 in-depth seminars on the changes to our credit laws. I'm aware that some of you will have watched our first 2 seminars, so I'll apologise in advance for any repetition of the outline of the session and the housekeeping. Many of you will have attended our overview seminar a couple of weeks ago. However, we know simply from the large number of attendees here today that many of you didn't. So if you missed it and you want to see a high-level summary of the Commission's 5 main areas describing what's changing, and those 5 areas are responsible lending, due diligence, directors' duties, fees and advertising, and certification, as well as having the opportunity to hear from Commission leaders discussing the education and enforcement approach the Commission is taking, then you can find a recording of our last session, the high-level overview session that we did a couple of weeks ago, on our website. The link's in the chat. We also made a series of informative handouts detailing the main changes that are underway. If you've not received these, you can email us, or they are available on our website, and again, the link will pop up in the chat function. I'd like to thank you all for filling in the surveys at the end of the last seminar. Your questions were really, really well thought out. They were relevant and they helped us make sure that these in-depth sessions deliver information that you want to hear about. So, as you know, we've used your queries to structure today's discussion, and we hope that it's useful for you. Today's seminar focuses on disclosure, and our expert, Crystal Uden, will be addressing some of your key questions, and she'll also be available for a more informal Q&A chat session at the end. But first, I'll open with karakia. Whakataka te hau ki te uru, whakataka te hau ki te taonga, kia mā kena kena ki uta, kia mā taratara ki tai. E hea ki ana te atakura, he teo, he huka, he hauhunga, ti hei mori ora. Before inviting Crystal to speak to you all, I'll quickly go over some housekeeping. If you have a technical issue, please raise your hand. It's under reactions in the bottom right of your screen, and we can see if we can assist in the chat function. You can also use the chat function to ask any questions that arise for you during our discussion today. Penny Fitzpatrick is handling our Zoom, and I'd like to introduce her now. Welcome, Penny, and thanks for helping us out.
Kia ora, Sonia, and kia ora koutou. I'll be handling the chat function today and putting through any of your questions to Crystal. You can pop these in the chat function or note them down in the survey that will pop up when you leave this webinar. Kia ora.
Thanks, Penny. Right, so please welcome today's expert, Crystal Uden. She's our head of legal for credit and has given lots of thought to the changes around disclosure. Welcome, Crystal.
Thanks, Sonia. Hi, everyone. No mai, haere mai, and welcome to this in-depth discussion on the upcoming disclosure changes. As Sonia said, I'm Crystal Uden, and I'm the Commission's Chief Legal Counsel of Credit. This is my 6th year at the Commission, and I've been working exclusively in the credit legal space in that time. So just like most of you, credit is my bread and butter. If you're logging in again today, having already seen me speak a couple of weeks ago on disclosure, my condolences. I really do appreciate you logging in again to hear about what can sometimes be considered an unexciting topic. So your presence today either means that you are so excited to see me speak again that I could literally speak about any topic, or I did my job right and explained to you the serious consequences that can occur if disclosure is not done properly. So for everyone joining us today, new and old, buckle up and get ready for an in-depth ride into the wonderful world of disclosure. To kick things off, as the purpose of today is to go through the changes and answer some of your questions from the last seminar, together with some live Q&A at the end, I thought we should kickstart with a question that came directly from you. So Sonia, could you please do the honours?
Absolutely. So a couple of questions that we had come in after the last seminars were around whether the disclosure obligations, both the old and the new, apply to mobile traders. And interestingly, this is a question that we've seen come across all of our subject areas. So Crystal, what should mobile traders be doing?
It's a good one to start with because everything I'll be talking today also applies to lenders and mobile traders. And I should start by saying that when I refer to the Act today, what I'm talking about is the Credit Contracts and Consumer Finance Act. So who is a mobile trader? Mobile traders are defined in the Act as someone who, in person and not at fixed premises, for example, a building, offers or agrees to supply consumer goods to an individual, either under a credit sale or where the goods are partly or fully financed by an associated company under a consumer credit contract. The Act also says that mobile traders who enter into credit sales are deemed to be creditors under the Act. As creditors, each of the disclosure requirements, initial, continuing, variation, request, the list goes on, all apply to mobile traders. And there's nothing extra that mobile traders need to do. Lenders and mobile traders have the same disclosure obligations.
Thanks, Crystal. Hey, so before you start taking us through what's changing, I think it would be helpful if you could take us through the disclosure basics first.
No problem, Sonia. Like I discussed at the last seminar, there are 4 core types of disclosure already in play. The first one is initial disclosure under Section 17. That's the stuff that lenders have to disclose before their borrowers enters into their loans. It's all the stuff that can be found in Schedule 1 that's applicable to the loan. And if lenders don't disclose it, then the default position is that they can't collect interest and fees. The second core type of disclosure is variation disclosure. It can be found in sections 22 and 23. That's the stuff you have to disclose when you and your borrower, or just you, the lender, vary the contract. Variation disclosure can sometimes appear complicated, and I know that lenders are sometimes worried that they aren't disclosing everything they're meant to and that they might get caught out. So I'm happy to say that I'll probably spend a good 5 to 10 minutes today just on that topic. And I'm hoping that the information I give to you, the lenders, will hopefully make your jobs easier when it comes to disclosing variations in the future. The third core type of disclosure is continuing disclosure. That's under Section 18. And it's the disclosure that's generally required every 6 months of the loan term. And finally, request disclosure under Section 24 is the disclosure that lenders must provide if requested by the borrower or their advocate. So those are the 4 core types of disclosure. I'm now going to focus on what's coming, the new changes. As most of you will know, those changes were meant to come into force on the 1st of October. However, with COVID-19 and its impact on the recent alert levels, I myself am sitting in level 4, Cabinet decided to extend that date by 2 months to 1 December. So for all the changes I'm talking about, you'll have an additional 2 months to get your systems and processes in order. A couple of weeks ago, I talked about the new disclosure obligations coming in, and I'm pretty sure it's time for Sonia to get a question. So can you remember how many new types I told you were coming?
So I'm pretty sure it's 3. I hope that's right.
Yeah. So I won't quiz you on what they are, but they are financial mentoring disclosure, dispute resolution service disclosure, and disclosure before debt collection. So those were the 3 new types of disclosure I talked about. And I also covered 2 other areas. I covered regulations, which prescribe the information that also needs to be disclosed when you vary a contract, and some new rules around extra disclosure if you're advertising in another language. And I'll explain later why I say disclosure. I really appreciated all the questions that we had after I spoke about disclosure. Most of those questions cover one of the 5 changes that I discussed. So what I do is I plan to go through each of those changes again with a little bit more detail and at the same time cover the questions that were asked. First, let's talk about financial mentoring and dispute resolution service disclosure. Those are 2 of the 3 changes that I said were coming. They are separate obligations, but they're similar enough that I feel we can talk about them at the same time. They also both carry the same consequences. Failure to disclose is an offence and can lead to fines of up to $600,000. And to find your disclosure obligations for both, you will need to look at Regulation 5A. Sonia, to give me time for some water, I think it's time for another question.
Sure. So when we did the survey at the end of the session last time, someone asked how the new disclosure obligations apply to current loans as at 1 December.
That's a great question because lenders should be aware of how the new obligations apply to current and new contracts. And I'll make sure to cover it for all the other areas we talk about too. But in the meantime, for financial mentoring and dispute resolution service disclosure, the new obligations apply to new contracts from 1 December, as well as existing or current contracts which are live as at 1 December. So what is financial mentoring disclosure? Well, for financial mentoring disclosure from 1 December, if your borrower defaults, makes a hardship application, or you decline a high-cost loan application, then you must disclose information about financial mentoring services. Just want to pause here quickly to give you some important information about Regulation 5A, which is where I said you would find the information that you have to disclose if you need to disclose financial mentoring information or dispute resolution service information. Regulation 5A was introduced with the Credit Contracts Legislation Amendment Act. Since then, it has been substantially amended via the Credit Contracts and Consumer Finance Amendment Regulations. So you'll need to look in 2 places for the complete picture of Regulation 5A. But I'm going to save you some time in finding those and get Penny to right now pop into the chat box the links to the 2 places you'll need to look to find the complete Regulation 5A picture. One of the changes that occurred when Regulation 5A was amended, and we had a question around this, is clarity around when you have to provide financial mentoring disclosure if you're sending a payment reminder. Regulation 5A, sub-regulation 3, now provides that from 1 December, if you're sending a payment reminder and the payment is overdue for more than 10 working days, it's at that point that you must provide the financial mentoring information. Chapter 12 of the Responsible Lending Code, the revised version, which is in force from 1 February next year, also has recommendations for what to include with other payment reminders. So for example, Chapter 12 recommends that lenders include financial mentoring information when sending payment reminders, regardless of how long the payment is overdue. We got asked a few questions about what must actually be disclosed for financial mentoring disclosure. So let's look at that. I've summarized for you on the slide what must be disclosed come 1 December. Of course, if Regulation 5A is amended again, then you will need to follow that amendment. I should note that copies of these slides will be made available to you at the end of the seminar, so please don't feel you need to copy down what's on the slide. Regulation 5A currently provides that you will need to disclose a statement about the availability of free and confidential advice from an independent service, and the name and contact details of a building financial capability service funded by the Ministry of Social Development that provides such a service. You might be wondering why I've underlined independent service. I've underlined that the service must be independent because we had a question at the last seminar about whether a lender who works with their borrower to create a budget plan from the borrower's income expenses could be considered a step under the financial mentoring disclosure. The answer is no. Obviously, lenders who want to work with their borrowers to help with their budgeting are free to do so, but this does not meet their obligation to provide information about free and independent mentoring services. I should also note here that the statement that must be provided is a statement about the availability of the services. It's not a requirement for you as the lender or mobile trader to provide those services or take any further steps.
That's great, Crystal. Thank you so much. And so just to reiterate, we are going to make those slides available. We'll email them out to everyone who registered to attend this seminar, along with a link to the recording that we're making today. And we've had a question come through on the side saying they can't access the survey. The survey will open as soon as this session is finished. You'll have a chance to put more questions in if we haven't covered them off at the end of this session. You'll close this window and it'll take you through to another link. So I reckon, Crystal, that we could probably jump in now with a question that we've got here, which is about what services should be disclosed. So it says a New Zealand-wide trading lender asked what service it should disclose for financial mentoring disclosure, as its borrowers are scattered all over New Zealand.
Thanks, Sonia. The first point I would make in answering that question is that financial mentoring disclosure is tailored to a borrower's particular circumstances. It's triggered by something that the particular borrower has done or applied for. The lender should therefore be able to point that particular borrower to a financial capability service that is in the local area to that borrower. The Ministry of Social Development's website has information on how to find local services for your particular borrowers. The second point I'd add is, if the lender is unable to provide information about a locally based service, then the lender may be able to disclose the availability of a nationally based service instead. So for example, the lender may be able to disclose information about FinCap. FinCap is the national entity for the building financial capability sector, and it's funded by the Ministry of Social Development. Further information about the services available at www.fincap.org.nz. And Penny, could you please pop that in the chat box for you guys? Now, turning to dispute resolution service disclosure, from 1 December, if your borrower makes a hardship application, complains about enforcement action, or makes any other complaint which is covered by the regulations, then you must disclose information about your dispute resolution scheme. Now, makes any other complaint covered by the regulations is pretty broad. Regulation 5A says the other types of complaints that are covered are expressions of dissatisfaction, where your borrower explicitly or implicitly expects a response or a resolution, and it's about something that relates to your financial service of being a creditor under a consumer credit contract. Again, we were asked what must actually be disclosed for dispute resolution service disclosure. So again, I've summarised for you on the slide what must be disclosed come 1 December. And just as with financial mentoring disclosure, if Regulation 5A is amended again, then you will need to follow that amendment. Regulation 5A currently provides that you will have to disclose the name of your dispute resolution scheme and the scheme's contact details, and a statement to the effect that your borrower has access to the service, that the service is free, and that the service may help to investigate or resolve the borrower's complaint if their complaint has not already been resolved to their satisfaction using your internal complaints process.
Oh, that's great, Crystal. Thank you. So the same New Zealand-wide lending trader has also asked what dispute resolution service it should disclose for its borrowers, as they are scattered all over New Zealand.
Well, again, here, the key is that the lender should already be a member of a dispute resolution scheme, as that's a requirement of the Financial Service Providers Act. So it is that dispute resolution service that must be disclosed, regardless of the location of the borrower or the service.
That's great.
So unless there are any other questions on that one, I think it's probably enough about financial mentoring and dispute resolution service disclosure for now. So let's move on to disclosure before debt collection. First things first, this requirement applies to existing and new contracts from 1 December, and failure to disclose is an infringement offence and you could be fined up to $30,000. The disclosure must be provided before any debt collection steps start, and there are some exceptions about this which I spoke about last time, for example, whether goods are at risk.
Crystal, I wonder if we could have some clarity around the definition of debt collection. There's been a question pop up in relation to that. So could you give us some further details about what the definition of debt collection is?
The definitions for debt collection and debt collector can be found in section 132A. Debt collection in particular is defined as an act to recover or attempt to recover any money that's owing by a debtor under a credit contract as a result of the debtor's breach of the contract. So that's pretty broad. And debt collector is similarly broad. It means, in respect of a contract, a creditor or any other person engaging in debt collection in respect of the contract that they're collecting under. So again, let's look at what must actually be disclosed before debt collection starts. Again, I've summarized for you on the slide what must be disclosed come 1 December. This time, what must be disclosed is covered in Regulation 23. Regulation 23 currently provides that you must disclose information that will help your borrower identify the credit contract. This includes your name, the date of the contract, the type of the loan, etc. It's things that will help your borrower identify the loan so they can know what the debt is about. You could also consider even providing a copy of the credit contract if you have it, but this is not a requirement. You must also disclose a statement about the debt. You'll need to refer to Regulation 23, sub-regulations 3 and 4, because there are specific requirements of what must be in that statement. What you have to disclose depends on whether the loan is of the type where you must provide continuing disclosure. So I recommend you have a look at those subsections just to check with the statement you need to provide complies with subsection 3 or subsection 4. You must also disclose information about the debt collector. This includes the full name and contact details of the debt collector and information about where the borrower can go to complain. This includes details for your dispute resolution scheme and even information about the Commerce Commission. You must also disclose a statement about the borrower's right to apply for unforeseen hardship under Section 55, together with information for the borrower on how to make such an application. And finally, you must disclose a statement to the effect that if the person has concerns about their finances, they can get free and confidential advice from an independent service. This must be disclosed together with the name and contact details of a building financial capability service funded by the Ministry of Social Development. That'll probably all sound familiar given what we've already talked about. I'd note even that there are even requirements on where you put certain information in your debt disclosure statement, so you will need to look at Regulation 23 closely. As I said earlier, all that information must be disclosed before debt collection starts. But it must also be disclosed again if a person becomes a debt collector after the debt collection has started. In that case, it must be provided within 10 working days of the new debt collector starting. Depending on how many debt collectors are involved in the entire process, it may mean that your borrower receives a couple of debt collections disclosure statements during the course of the collection. That's okay, as each time the borrower will be receiving update information about their debt and who they can contact if they have any issues. Now, I can recall we had a question around this, Sonia. Can you ask it?
Yeah, we did. So this definitely came through from the last seminar. And I can see in the chat, we're getting a couple of questions around, what constitutes the start of debt collection. So we might cover that off at the end. And just so for everyone on the chat, we've got someone in the background noting things down so that we can get to them at the end. And so when we think about this question that came in last time, it was quite a good one. And the person asked, so if a new debt collector starts after debt collection commences, and we know they've got 10 working days to disclose the debt collection information in Regulation 23. The question is, since you've only just become the debt collector, you won't have the last disclosure statement. Do you have to populate one?
Oh, yeah. So the disclosure statement that's relevant here is the Section 19 continuing disclosure statement that the lender most recently sent. So as a new debt collector, you won't have a last disclosure statement yourself. You'll need to ask the lender for their most recent Section 19 continuing disclosure statement and then populate your statement about the debt from that.
Thanks.
I'm tentatively waiting for all those live Q&As, but in the meantime, I've talked enough, I think, about the 3 new types of disclosure coming in. They were financial mentoring disclosure, dispute resolution service disclosure, and disclosure before debt collection. So now I'm going to talk to you about variation disclosure. There are 2 types of variation disclosure. Disclosure when you and the borrower agree a variation, and disclosure when you've unilaterally varied something in the loan. They're covered by Sections 22 and Section 23. We've recently amended our disclosure guidance again, that was last week, to provide even more clarity around what must be disclosed when a loan is varied. I really recommend you grab yourself a copy from our website if you don't already have one, and look in particular at Section E, which covers variation disclosure. Penny is right now going to pop into the chat box a direct link to our credit guidelines, so no excuses if you can't find it. Before we get to the questions that were asked around this subject, let's first go through what is required for the 2 types of variation disclosure. This table is a quick guide to variation disclosure. Looking first at agreed variations, your obligations are currently set out in Section 22. Timing-wise, agreed variation disclosure must usually be provided before the change takes effect. For high-cost consumer credit contracts, agreed variation disclosure must always be provided before the change takes effect. But if the loan is not a high-cost consumer credit contract, then there are some limited circumstances where disclosure can be provided after the change takes effect. And these are set out in Section 22, Subsection 3. Now we turn to the crux of variation disclosure. What must you actually disclose when you agree to vary a loan? Section 22, Subsection 1 provides that for an agreed variation, full particulars of the change must be disclosed, together with any other information prescribed by regulations.
That's super handy, Crystal. And I think just reminding everyone that the slides will be available at the end of the session. And so you don't have to quickly note that down. You can have a copy of the presentation. I also want to acknowledge everyone's patience around any internet kind of glitches. We're really grateful that you're bearing with us as we navigate working remotely. Thanks.
Yeah, so the full particulars of the change, which I mentioned from the previous slide, that one's not defined in the Act, but we do have a view on what the Commission considers that means. The Commission considers that full particulars of the change requires lenders to disclose the change together with all the information required to be disclosed for that category of information in Schedule 1 and the effect of the agreed change on any of the remaining key information in Schedule 1. From 1 December, this is where the change comes in, lenders will also need to comply with Regulation 4F when there is an agreed variation. Regulation 4F provides that in addition to the full particulars of the change, lenders must also disclose additional prescribed information if the change affects the credit limit, the annual interest rate, total interest charges, payments required, and credit fees and charges if the loan is a high-cost consumer credit contract. I know we had a couple of questions around variation disclosure from the last seminar, Sonia, so let's go through those.
Yeah, sure. So the first one that we've got asks, do lenders have to provide variation disclosure if the change has occurred due to a hardship request or a temporary change in contract terms to assist the borrower?
Yeah, so in both those situations, lenders will need to provide variation disclosure. With temporary changes, the disclosure may be able to be provided after the change has taken effect, provided the requirements of Section 22, Subsection 3 are met.
Thanks, Crystal. Here's another one then. If a customer makes a shorter term payment arrangement, which will revert to the original payment amount after a period, will the lender still need to provide variation disclosure? Now,
That's an easy one. Yes, because that's an agreed.
Oh, perfect. Thank you. Thanks, Crystal. Now, so just one more. A lender has asked if a variation disclosure had to be a document, or can it be in an email, like an email confirmation to the client?
That's a good question. There are no specific forms or formats that lenders must use to provide variation disclosure in order to comply with the requirements. The standard requirements for disclosure are the ones that will need to be followed, and they're set out in section 32. The disclosure can be emailed if the borrower or guarantor, if applicable, has agreed to receive disclosure in that manner. So unless there are any other questions, Sonia, I think I'll move to unilateral variation disclosure.
There might be some at the end, but I think it's
Okay.
really good to keep moving on so that we can get through the guts of this. Thank you.
No problem. All right, well, let's look at the Commission's suggestion for how to provide agreed unilateral variation disclosure. This is the, I apologize. This is the example of how we consider the Commission, this is the Commission's view of a good way to provide agreed variation disclosure. This is the example that we put in our revised disclosure guidelines recently. It's one way we recommend lenders consider disclosing their agreed changes. This way shows the borrower the full effect of the change. There's no requirement to disclose it in this way, rather a recommendation from us for you to have a look at, because we feel it's a good way to show the borrower the change together with the effect of the change. We did have a question about this table from one lender at the last seminar. They wanted to know what current means in the middle column. So in this example, current means what is in place before the variation takes effect. So here, the borrower is currently paying $200 a week and wanting to reduce that to $50. Let's go back to that quick guide to variation disclosure table. Turning to unilateral variations, which is where the lender imposes the change without the borrower's agreement, then your obligations are set out in section 23. Timing-wise, unilateral variation disclosure can usually be provided within 5 working days of the change taking effect, or with the next continuing disclosure statement, depending on what you have varied. Again, back to the crux of what is variation disclosure. What must you disclose when you unilaterally vary a contract? Section 23.2 also provides that the full particulars of the change must be disclosed together with any other information prescribed by regulations. As with the Commission's approach to agreed variation disclosure, the Commission considers that the words full particulars of the change require lenders to disclose the unilateral change together with all the information required to be disclosed for that category of information in Schedule 1, and the effect of the unilateral change on any of the remaining key information in Schedule 1. From 1 December, lenders will also need to comply with Regulation 4G when there is a unilateral variation. Regulation 4G provides that if the contract is a high-cost consumer credit contract, lenders must also include a statement of the rate of charge if it is affected by the change. Sonia, were there any questions about unilateral disclosure?
Yeah, there was just one. But first, I'll just quickly acknowledge that the Prime Minister is about to speak in relation to the alert levels around the country and in Auckland. And I just want to acknowledge that for some people, you might have your attention half fixed on your phone, and we totally understand and appreciate that. Remember, the session's being recorded and will be sent to you. So, and I can see there's lots of questions coming through, which is fantastic. We will have time at the end. Crystal and I are really happy to go over if that's necessary as we work through some of those, the ones that we're able to answer. So in relation to unilateral disclosure, there's one question from the last session that we thought, is could be useful for everyone to hear about. A lender asked if they would need to provide unilateral disclosure for changes to a floating rate.
Yes, the Commission considers that floating rate changes will need to be disclosed as it's a unilateral variation. So in that example, what would need to be disclosed is the interest rate together with the information required to be disclosed by Schedule 1 for interest rates, and the effect of the change on any of the remaining key information in Schedule 1. For example, if the repayment amount changes, then that will need to be disclosed. Before we close off variation disclosure, the thing that I haven't yet covered off is whether regulations 4G and 4F apply to all contracts from 1 December. And I can confirm that regulations 4G and 4F apply to new and existing contracts from 1 December. The final thing I'll talk about before we finish with the live Q&A is extra disclosure if you're advertising in another language. This one is the odd man out because it isn't technically disclosure, and I'll explain to you while I keep doing this. Disclosure as we know it is prescribed information that must be disclosed at certain points during the contract. For example, before the contract is entered into, you have to provide initial disclosure. When the contract is varied, variation disclosure, etc. What you have to disclose in each of those circumstances is very prescribed, and we know that the consequences of not disclosing properly can be very high. For example, Section 99(1)(a). This new requirement can be found under the amended Section 9C. The requirement is, if you advertise in a language different from the one you use in your loan agreement, and the advert is less than 6 months old, then you may need to take reasonable steps to offer information about your loan agreement in the advert language. The key here is offering enough information in the advertised language to ensure that your borrower can reach informed decisions. What you disclose is at your discretion, as it's not prescribed. Obviously, if you wish to translate all your documents into the advertised language, then that might be an option. But we would caution you to make sure that your translations are accurate. If your translation provides a different impression or is even different to your loan document, then the version which is most favorable to your borrower is the one that will apply. I think the key here is going to be quality over quantity in what you provide and making sure that what you have provided is accurate.
Crystal, I understand that the revised Responsible Lending Code also recommends that where you suspect that your borrower doesn't have a good understanding of the language your loan documents are in, that you have processes in place to pick that up and then offer them information about your agreement in the language that you've been advertising in. Is that right?
Yeah, that's a great point. Thanks, Sonia. And I should also note here that this obligation also applies to your guarantors and information that you may need to give them about their guarantees. Failure to meet this obligation could lead to a pecuniary penalty of up to $600,000. So it's important that you have processes in place to prepare for this. And finally, how the provision applies from 1 December. This obligation applies to new and current advertising as at 1 December. What that means is, if you've advertised or will advertise after 1 June this year in a language that is different to the language in your loan document, then you may need to offer information about your loan agreement in the advertised language. So have a think right now about what language you're advertising in, because come 1 December, this new obligation might apply to you. One of the questions we had from the last seminar was how the Commission would assess compliance in different languages. If the Commission were investigating this obligation, we would obtain translations of your documents and then compare them to the loan document. Again, if the translated document did not match the terms of the loan agreement, then the terms more favorable to the borrower are the ones that will apply. Were there any other questions about this advertising obligation, Sonia?
Yeah, there was one that came through that said, if I create a checkbox on my application form to ask whether English is a second language and it's ticked, do I then need to provide further information to the customer in their preferred language? Or is it okay with them to check whether they're okay to converse and read the contract and things in English? What do you think?
Well, I'd say as responsible lenders should be engaging with their borrowers to understand their English proficiency if they confirm especially that English is their second language. It's okay to check with borrowers if they are okay to continue in English, but if they're not, then lenders should have processes in place to engage with them in another language. Or if it's not possible to do so, then lenders will need to consider how they can further assist their borrowers if they're unable to converse with them in a language that they understand. I would also add here, if the lenders discover that their borrower or guarantor or both, does not have a good understanding of the English language, then they are likely to be a vulnerable borrower or guarantor, as defined in the Responsible Lending Code. So if so, the code recommends additional measures that lenders take to ensure that the agreement will meet the borrower's requirements and objectives, and that the borrower understands the implications of entering into that loan.
That's great, Crystal. Thank you.
Thank you. So that sums up our deep dive into the questions that were asked about disclosure after the last seminar. Those are the 5 disclosure or disclosure-esque areas that you're going to need to be ready for come 1 December. And I believe it's now time to do some live Q&A. So Sonia, go easy on me, please.
Well, there's been lots and lots of questions coming through, but it's interesting. There's lots of similar questions coming through, and I think that's a really good sign. So there's one question here that kind of reflects a couple of questions that came through, and it says, what's the point of disclosure before debt collection? What will borrowers be getting from it?
Yeah, I understand the intention of disclosure of that information at that point is to increase transparency around the debt owed and how the debt's made up, making it easier for the borrower to identify potentially unreasonable fees, what the debt actually is. And I feel that it will also encourage debtors to access help earlier and hopefully tidy up debt quicker than maybe would have happened if they weren't aware of places that they could go to for assistance.
Thanks. So there's another question here regarding missed payment reminders, and I think that also sort of echoes lots of the comments that were coming through. So the question is, would a missed payment reminder or a default notice amount to debt collection activity? Are those sorts of activities, are they considered debt collection?
So payment reminders wouldn't be considered debt collection for the purposes of the disclosure before debt collection. And what was the other?
A default notice.
Yeah, I think it would depend what the contents of the default notice were. So remember when I said debt collection is quite a broad definition, and it is under section 132A. It's really steps taken to recover money that's owed under the contract as a result of the debtor's breach of the contract. So it might be covered by that definition, but I think it would depend on what the substance of the notice was.
There's a question coming in about continuing disclosure. We'll get to that in a minute, but before I go there, there's a question about legal proceedings and the disclosure obligations. So the question says, do the same disclosure obligations apply prior to legal proceedings commencing?
Yeah, again, the debt collection definition is really broad, so it would include commencing legal proceedings. However, I would expect that at the time that the legal proceedings are brought, other steps have already been taken in the debt collection process in compliance with the responsible lending principles in the code. So in which case the debt collection disclosure probably will have already been provided. And I should note that debt collection disclosure only needs to be provided once, not before each step in the debt collection process, unless of course you're changing debt collecting providers, in which case the disclosure must be provided again.
That's great, Crystal. Hey, so I'm conscious that we've nearly been going for 45 minutes. Let's do one last question, which is about that continuing disclosure, because that's come up a couple of times. So someone asks, they obviously know their stuff, does section 99 subsection 1A cover continuing disclosure?
Well, good thing I know my stuff because I know the answer to that one. Section 99(1)(a) is a consequence for failing to provide initial and agreed variation disclosure. So no, it doesn't apply to unilateral disclosure.
Okay,
continuing disclosure.
Continuing disclosure. Thank you. Thanks, Crystal. Look, we're so grateful for your knowledge and your experience and your time. Thank you so much for being our expert today. I think that's all we've got time for, but we've covered a lot of information. It's a lot to take in over Zoom. Remember, we've got the handouts, which have got those details in there, and you can email us if you need them. We are recording this and we can send you the slides. You'll also get the chat links come through with the recording. So thank you all for your patience and your attention. Crystal, is there anything else that you'd like to add?
No, I'm secretly, well, not so secretly, waiting for hopefully a level 3 announcement, just like I'm sure most Aucklanders are. But thank you for the really great disclosure questions. You know, it will help us formulate what are some frequently asked questions that maybe we go out to the industry with later on. And like we said, the slides will be available, this recording will be available, and our disclosure guidelines, they're in depth. They've got examples now, they've been updated, so highly recommend you go through those.
That's fantastic. Thank you, Crystal.
Thank you.
And thanks to all of you for watching and engaging with this webinar. So just like last time, we're running a survey where you can let us know what we've missed or what areas you need more details around. And if you can't access that survey for whatever reason, you can always email us your questions. We'd love to hear from you. So at the end of this session, when you close the window, you'll be redirected to an anonymous survey. Pop your questions in here and also let us know what you thought. It helps us to improve. So when the window comes up, just click continue to go through to the survey. Any questions, or if you'd like to have more information about this session or any of the other sessions, you can email us at credit.advocacy@comcom.govt.nz. So we have 2 more sessions tomorrow, advertising and fees at 10:30 and certification at 11:30. So kia ora koutou for your great listening skills. I'll close as we started with karakia. Uruhia, uruhia, uruhia ki te uru tapanui, kia wātia, kia nāma te nāko, te tiana te wairua e te ara tangata, koe rā e rongo, whakaere ake ke runga, kia tine, tine huie, tae kie. Thanks everyone. Haere rā.